Hey everyone, welcome back to Fintelliq. If you are a high income earner, a doctor, an engineer, a business owner, anyone pulling in six figures, I need you to stop scrolling right now because I am going to about show you something in IRS actually allows but almost nobody explains correctly on YouTube. It's called the Backdoor Roth IRA. And by the end of this video, you are going to understand exactly how high income professionals legally get money into a Roth IRA even though the law technically says they earn too much to contribute. We are also going to cover the single biggest mistake people make with this strategy, a mistake that can quietly turn a tax-free move into a surprise tax bill, and I will show you the professional level fix for it too. So grab a coffee, stay with me till the end, and let's get into it. Here's the roadmap for today's video. We are covering 5 things step by step. Number 1, the high income Roth dilemma. Why the IRS won't let high earners contribute directly to a Roth IRA in the first place. Number 2, the step by step execution protocol. This is the actual 2-step move: contribute, then convert. Number 3, the Pro-Rata Rule trap. This is the number 1 mistake that catches people off guard and creates a surprise tax bill. Number 4, the reverse rollover strategy. This is the advanced fix for that professionals use to make sure the conversation stays completely clean. And the 5th one, tax reporting. Specifically IRS Form 8606, so you stay fully compliant. Quick reminder to keep in your head as we go: the annual IRA contribution limit is $7,000 or $8,000 if you are 50 or even older. The income phase out for married couples filing jointly starts around $240,000. Keep those numbers in mind. Yeah, sorry for the issues. We will use them throughout the content. So here's the dilemma. A Roth IRA is genuinely one of the best accounts in the entire tax code. Your money grows completely tax free and you retire and start withdrawing it. You don't owe a single dollar in tax on it. Growth tax free, withdrawals tax free. Sounds amazing, right? Well, Congress put a limit on who's allowed to contribute directly. So if you are a single player, once your income, specifically your modified adjusted gross income, or married, crosses about $146,000, your ability to contribute starts shrinking. By the time you hit around $161,000, it's completely gone. Zero. If you are married filing jointly, that same phase out happens between roughly $230,000 and around $240,000. So if you are a high earner and the front door to a Roth IRA is locked, but this is the whole point of today's video, that is, there's a completely legal side door, and that's what we are about to open. So how does this side ever even exist? This goes back to a law called TIPRA, the Tax Increase Prevention and Reconciliation Act 2005. Before 2010, if you wanted to convert money from a traditional IRA into a Roth IRA, you also had an income limit, and if you made more than $100,000, you legally could not do a conversion at all. But starting in 2010, The Congress moved that limit completely. Anyone at any income level can now convert traditional IRA money into a Roth IRA, no cap, none. So here's the gap this creates. Contributing directly to a Roth IRA is still capped by income, but converting into a Roth has no cap whatsoever. That gap, contribution capped, conversion uncapped, and is the entire foundation of the backdoor Roth IRA strategy. It's not a loophole in the shady sense. It's just how the current law is written, and high earners are simply using the rules as they exist. Okay, now let's get into the actual mechanics. This is a two-step process and this is simpler than people even think. Step 1. You make a non-deductible contribution. You put up to $7,000 into a traditional IRA or $8,000 if you are 50 or older, since your income is too high to qualify for a tax deduction anyway. You are not claiming one. The money goes in as after-tax dollars. It just sits there temporarily and usually in a money market or cash position while it clears. Step 2. Once that money has cleared, usually just a few days, you convert the entire balance from the traditional IRA into the Roth IRA. So, and here's the step 2. Once that money has cleared, usually just a few days, you convert the entire balance from the traditional IRA into the Roth IRA. And here's the key insight. Because the money went in after tax and you convert it before it earns and any real interest, the conversation creates zero new tax liability. You already paid tax on this money. When you earned it, you are not getting a zero tax break. You are just repositioning it into a tax-free account. So one important timing tip: convert as soon as the cash settles. So if you let it sit too long in that money market account, it will start earning a small amount of interest, maybe $5 to $10, and that little bit of interest actually becomes taxable and adds a small compilation to your reporting. So you don't wait around, contribute, then convert quickly. So now here's where most people mess this up, and I want you to pay very close attention to this section because this is the single most common and most expensive mistake in the entire strategy. It's called the Pro-Rata Rule and it comes from IRC section 408D2. Here's the problem: the IRS does not look at your non-deductible IRA in isolation. At the December 31st of the year, you convert the IRS lumps together, every single pre-tax IRA dollar you have, and treats it as one giant pool. That includes traditional IRS, SEP IRS, simple IRS, and rollover IRS from old 401ks. Then it applies a simple formula. Your tax-free percentage equals your total non-deductible basis divided by your pre-tax IRA balance across all these accounts combined. So if you have a lot of pre-old tax IRA money sitting around from a previous job and you think you are doing a clean tax-free backdoor route, you might be in a nasty surprise. Let's see exactly what this looks like and in real numbers. So let's walk through a real example. So this really clicks in. Say an investor has $93,000 sitting in old rollover IRA. Pure tax-free money from as previous 401k. Now they contribute $7,000 non-deductible and try to convert that same $7,000 into a Roth. You would think, great, I converted exactly what I put in, so it's all tax-free. But that's not how the IRS sees it. At the $93,000 pre-tax and the $7,000 non-deductible together, and your total pool is around $100,000, your non-deductible basis of $7,000 is only 7% of that pool. So only 7% of your conversion, just $490 comes out tax-free. The other 93%, which is $6,510, get taxed as ordinary income this year. Even though your intention was completely tax-free, backdoor Roth, this is a trap. If you have old pre-tax IRA money hanging around, converting even a single non-deductible distribution can trigger a real tax bill you were not expecting. So how you avoid this? That's exactly what we are covering next. Here's the professional level fix, and it's called the Reverse Rollover. So the key fact that makes this work after retirement plans, your current 401k, a 403b or a solo 401k are excluded from the IRS Pro-Rata calculation. The IRS only pulls together the IRA money. Money sitting inside an employer doesn't count. So here's the 4-step fix. Step 1. Identify any pre-tax IRA money you have. That's your rollover IRA, traditional IRA, or even SEP IRA balances. Step 2. Do a direct rollover, moving that pre-tax money out of the IRA and into your active employer 401k or solo 401k. Step 3. Confirm your traditional SEP and simple IRA balances are exactly $0 of 31st December. This is the critical checkpoint. Step 4. Now that your IRA pre-tax pool is empty, go ahead and do the clean $7,000 non-deductible contribution and convert it. Since there's no other pre-tax IRA money in the pool, 100% of the conversion is tax-free. This is exactly how high-income professionals with old 401k rollovers still execute a completely clean backdoor Roth every single year. So now let's talk paperwork, because doing the strategy correctly also means reporting it correctly. The core form here is IRS Form 8606 non-deductible IRS, and it gets filed along with your regular Form 1040. Part 1 of Form 8606 reports your non-deductible contributions and establishes your cost basis, basically proving to the IRS I already paid tax on this money. Part 2 reports the actual conversion from your traditional IRA into your Roth IRA. On top of that, your custodian, the brokerage holding your accounts, will send you 2 or more forms automatically. 1099R, which shows the distribution or conversion coming out of the traditional IRA, and a form of 5498, which shows the funds landing inside your Roth IRA. File Form 8606 every single year you contribute or convert. Skip it and you lose your proof of basis, which means you could end up paying tax twice on the same money down the road. Don't skip this step. Let's bring all of this together. I know that that's all a very big concept one. Here's everything you need to be clear. Direct Roth contributions phase out at high incomes, but conversations have no income limit at all. Contribute non-deductible funds to a traditional IRA, then convert quickly before any interest builds up. Watch out for the Pro-Rata Rule. It aggregates every pre-tax IRA dollar you own, not just the new contribution. If you have old pre-tax IRA money, use a reverse rollover into a 401k to isolate it and keep your conversation 100% clean. And file Form 8606 every single year you do this without fail. Quick disclaimer before we wrap up this video. This video is fully for educational purposes only from Fintelliq research, and it's not personalized tax, legal or financial advice. Backdoor Roth mechanisms depend on your individual situation and your current IRS rules, so please talk to a CPA or tax attorney before executing any of these moves yourself. So if this video helped make a genuinely confusing tax strategy click for you, do me a favor, hit the like button and the subscribe button, and let me know in the comments what high income tax topic you want to break down next. So thanks so much for watching, and I will see you in the next one. And you please put down in the comments for any kind of mistakes. I will rectify it soon for coverage. Thank you.